As of 9:57 a.m. Eastern Time, Applied Digital Corp, ticker APLD, is trading at about $22.84, which is down about 0.95% or 22 cents on the day. The volume is already heavy, with over 7.2 million shares changing hands in the first half hour of trading. But that small intraday move is completely misleading. It masks the absolute carnage that just happened. If you're just tuning in, you missed the real story, which was yesterday's 12.7% collapse. This stock is the perfect example of a brutal collision between a fantastic story and a terrifying financial reality. The expectation is that APLD is a golden pick-and-shovel play on the artificial intelligence build-out, a way to get NVIDIA stock-like exposure without buying NVIDIA itself. The reality? Yesterday, the market was forced to look at the bill for that growth, and it did not like what it saw. This isn't a simple tech story. It's a high-stakes infrastructure bet that is now drowning in debt. And the smart money is starting to get very nervous. Let's be clear about the common belief, the one that has driven this stock from a 52-week low of $3.31 to a high of over $40. The narrative is simple. AI needs a shocking amount of power and specialized data centers, and Applied Digital is one of the few pure-play companies building them. They've announced mind-boggling long-term contracts. We're talking an $11 billion 15-year lease with CoreWeave for 400 megawatts of capacity at its Polaris Forge 1 campus. We're talking another $5 billion contract with a different US-based hyperscaler for 200 megawatts. This is the kind of stuff that makes investors on Robinhood and SoFi Invest drool. It looks like guaranteed long-term revenue. It looks like the next great secular growth story, the kind of online investment that defines a decade. The expectation is that you just buy the stock, wait for them to flip the switch, and watch the cash roll in. But that expectation just ran headfirst into the reality of what it costs to build these AI factories. Here is what actually happened. Yesterday, the company announced it was pricing a $2.35 billion private offering of senior secured notes. Let me repeat that. $2.35 billion. This is for a company with a market cap of just over $6 billion. This is a massive slug of new debt, and it's not cheap, carrying a 9.250% coupon due in 2030. As if that wasn't enough to spook investors, the company also announced it expects to draw down another $787.5 million from its preferred equity financing facility with Macquarie. This is the financial equivalent of trying to put out a fire with gasoline. The market saw this one-two punch of massive debt and potential dilution from the preferred equity and immediately hit the sell button. That 12.7% drop wasn't a panic. It was a rational repricing. It was the market realizing that the $11 billion contract from CoreWeave isn't free. It has to be built first, and the price tag is staggering. This is where the story gets complicated, far beyond the simple bull case. This is a construction company racing against a clock funded by high-interest debt. S&P Global just assigned a B+ rating to the company, which is deep into speculative territory. Their report was telling. They see the high earnings visibility from the contracts, but they also highlight the significant construction risk. In fact, their report notes that CoreWeave has the right to terminate the lease if Applied Digital delivers the facility more than 180 days late. So this isn't a stable tech stock like Apple stock. This is a high-beta, high-risk venture where everything has to go right. The company has a beta of 6.77. That is an astoundingly high number, signaling volatility that would make most Fidelity wealth management clients sick to their stomach. This is a stock for active traders, the kind of person using interactive brokers to manage a complex, high-risk position, not something you just stick in your Schwab intelligent portfolios. The recent Q1 earnings, reported back in October, should have been a warning. Yes, they beat on revenue, posting $64.2 million, but they still posted a net loss of $28.7 million. More importantly, their averaged adjusted EBITDA was just $0.5 million. That is razor thin. It shows a company burning cash to build out its capacity, and that was before this new $2.35 billion debt load. That debt, which was $687 million at the end of the quarter, is now set to balloon. This is the central tension. The contracts are in the future, but the interest payments are now. The company is in a race to get its data centers online and generating revenue before the cost of its capital eats it alive. This is a very different proposition than what most people think they're buying. Many are looking for investment help in the AI sector, but this stock isn't a simple solution. It's a complex problem in financial engineering. Let's look at who is making these bets. The institutional ownership data is fascinating and shows the deep split in opinion. Fillings for the third quarter showed that giants like the Vanguard Group and BlackRock actually added to their positions. They are clearly taking the long view, believing the contracts are worth the construction risk. But if you look at fillings from the quarter before, you'll see that major funds like D.E. Shaw sold their entire position. Oasis Management and Clearfield Capital also dumped massive blocks of shares. This isn't a clear consensus. The big money is at war with itself. Some see a generational opportunity, while others see a balance sheet that is about to snap. This is what makes online investing so difficult. The headlines tell you about the $11 billion contract, but they don't scream about the 9.250% interest rate on the $2.35 billion in debt you're taking on to get it. This is why a simple Robinhood app interface can be so dangerous. It makes a stock with this much underlying risk look just like any other. So what does Applied Digital actually do? It's important to understand the business model. The company started life in the crypto mining world, building facilities for that. But management saw the coming AI wave and pivoted hard. They are now in the business of designing, building, and operating next-generation high-performance computing data centers. These are not your grandfather's data centers. They are specialized facilities, often using proprietary waterless cooling, designed to handle the immense power draw and heat output of thousands of NVIDIA H100s or other AI accelerators. They build the shell and the infrastructure, and the customer, like CoreWeave, leases the entire facility for 10 to 15 years. It's a fantastic model if, and only if, you can manage the upfront capital expenditure and construction timelines. That if is now a $2.35 billion question. This company is taking on billions of debt to fund its contracts. Comment below. Do you see this as a brilliant high-growth bet or a reckless financial gamble? Looking forward, the pathways for this stock are extreme. There is no middle ground here. The bull case, the expectation, is that Applied Digital executes. They finish the Polaris Forge 1 and 2 campuses on time and on budget. CoreWeave and the other hyperscalers move in, the leases commence, and the revenue starts flowing. In that scenario, the $2.35 billion in debt is easily serviceable, and the company's earnings explode. The stock would, in that case, likely fly past the analyst median targets in the $37 to $40 range. This is what the bulls at Fidelity or SoFi, who are still buying, are betting on. They are making a self-investing bet on execution. They're looking at the $11 billion contract and seeing it as a done deal. But the bear case, the reality check, is just as plausible. Construction is hard. Supply chains for critical components like switchgear and transformers are still tight. S&P warned about it. A 180-day delay, which is not a lot of time in a multi-year billion-dollar construction project, could be catastrophic if it allows a customer to terminate the lease. So this isn't a stable tech stock like Apple stock. This is a high-beta, high-risk venture where everything has to go right. The company has a beta of 6.77. That is an astoundingly high number, signaling volatility that would make most Fidelity wealth management clients sick to their stomach. This is a stock for active traders, the kind of person using interactive brokers to manage a complex, high-risk position, not something you just stick in your Schwab intelligent portfolios. So as we watch APLD churn here around $22.84, trying to find its footing after yesterday's 12.